Hello, my name is Elliott Gue. I'm editor of Personal Finance as well as The Energy Strategist. Today I want to talk a little bit about what I see ahead for the economy as well as some of the sectors and individual stocks that I think are well placed here. As far as the economy is concerned, I think what we're seeing right now is a cyclical recovery from very depressed levels in late 2008, early 2009. It differs in many ways from recoveries of the last 30 years or so, in the sense that it's much less robust. We're probably not going to see quite the same level of economic growth that we typically see at this stage in a recovery going forward. However, I do think there's enough there for us to see somewhat of a bounce in the economy. One of the indicators I look at very closely and that I talk a lot about in Personal Finance as well as my free e-zine, Personal Finance Weekly, is the LEI, the U.S. Leading Economic Index. It's put out monthly by the Conference Board, and the figure I really look at is the year-over-year percent change in LEI. And basically, when that drops below zero, in other words, when LEI is down year-over-year, that typically comes right before, a few months before, a U.S. recession. We saw that actually happen at the end of 2008, and it pretty much nailed the beginning of the most recent recession in December 2007. We saw it actually cross from below zero back to above zero last summer. That probably indicates that the U.S. recession came to an end last summer. Again, a very big difference between saying we're seeing a cyclical recovery and saying that there's a new bull market or we're off to the races again for the economy. I think it's going to be a very subdued recovery and a very subdued period of economic growth. More akin to a period like the 1970s than to a period from 1982 up to 2000. What are some of the challenges I think we face as a country in terms of economic growth? Well, one of them is just debt. There's excessive amounts of debt in the system right now. Household debt soared in the period from about 2000 up until about 2007. People took on very aggressive mortgages, and now they're having trouble financing that debt and staying on top of that debt. The other area, of course, is sovereign debt. The U.S. government, there's been a big explosion in spending here over the last couple of years. Ultimately, that means that the Treasury is going to have to finance that by selling more and more bonds. U.S. debt, government debt, federal government debt as a percent of GDP is going to soar to sort of unprecedented levels here over the next few years, based solely upon spending that we've already done. And that is a major risk. We've already seen that in December, China dropped from the largest holder of U.S. Treasury debt to the second largest holder. They actually sold off some of their Treasury holdings. Now, I'm not sure whether this is the beginning of a more important trend or not, but it certainly does indicate that some countries that have been essentially financing U.S. government spending by buying our bonds may be starting to get a little bit nervous about the debt levels that we're seeing. Obviously, everybody has heard of some of the troubles going on in Europe right now, specifically with Greece. There really is a renewed focus on sovereign debt and the risks that are apparent there. That said, on the other side of the coin, one of the areas that has been of a lot of focus in personal finance for us is emerging markets and the potential for growth in the emerging markets to sort of make up for weak growth or pretty stagnant growth in the developed countries around the world. You look at a country like China, it bounced back a lot more quickly than most people had expected. A lot of people ask me, is Chinese growth real? Well, I think it is. If you look at not just the Chinese government statistics on growth, look at how much oil China is importing. They're consuming new record levels in terms of oil consumption. Look how much coal that they're importing. Look at Chinese electricity generation, up 30% year over year in December. I think the Chinese economy is actually growing quite well. Look at India as well, another country that's doing very well. And a third country that we featured in the most recent issue of Personal Finance that's just coming out is Brazil. Another country that's done very, very well in recent years. It's really gotten its fiscal house in order and is growing quite robustly here. So I think that you're seeing sort of a dichotomy between very weak growth in the developed economies and pretty strong growth in the emerging markets. Overall, that does provide us with a number of opportunities. One sector that we've liked a lot for well over a year in personal finance is energy. Energy, of course, is extremely leveraged to what's going on in the emerging markets. On oil, for example, your average Chinese consumer consumes about 2 barrels of oil per person per year, compared to more like 21, 22 barrels of oil per person per year in the U.S. something closer to 15 in Japan, and sort of that 10 to 13 barrel per person per year range in Europe. So even though Chinese oil demand is growing faster than any other country in the world, they still have a long way to go to reach sort of developed world levels of consumption. And of course, the Chinese economy is very energy intensive relative to your developed world economies. In other words, each unit of GDP is more expensive in terms of energy consumed. So I think that's one area that's going to see a lot of growth.